Thanks for joining us. I'm Shannon Grein, and I'm joined today with my colleague Charlie Doughtery to discuss the latest changes to our forecast. So Charlie, we're obviously recording this in the middle of the federal government being shut down, so there's been limited data flow. How has that impacted how we expect the economy to progress in the next few months?
Thanks, Shannon. Yeah, so the federal government is currently shut down. We don't expect that to have a major impact on our overall economic outlook, mostly because we expect the government to eventually reopen. But it is impacting the data flow, as you point out, meaning a lot of the federal agencies that collect and distribute the economic data that we use to inform our economic thinking are currently closed. But the data we do have are actually pointing to a resilient pace of economic activity recently. So just to give an example here, for Q3 real GDP growth, we're tracking growth at a little over 3%. So that's a pretty solid result and actually represents an upgrade compared to our previous forecast update. So we are anticipating growth to slow down over the next few quarters. Mostly because we still have restrictive monetary policy. The economic environment is still very uncertain. Then as you kind of go ahead into 2026 and 2027, we expect stronger growth, mostly because we have the positive growth effects from expansionary fiscal policy, and we have the Federal Reserve, which is bringing the federal funds target rate lower. So overall, what we're seeing right now is a resilient pace of activity. One big support factor right now is strong growth in AI and other high-tech investment. But overall, Shannon, what are we seeing in the household sector? What's going on with the consumer?
Yeah, so I think part of our revision in the last month was mostly concentrated in consumer spending. So consumer spending has been remarkably resilient this year. Since our last forecast update, we did get GDP revisions that brought up the pace of real consumption expenditures in the second quarter pretty significantly. So the near-term trend in terms of consumer spending has been very strong, which led us to revise up the third quarter estimate. So we now expect real personal consumption expenditures to expand at double the pace we were anticipating just last month. So we look for consumer spending to rise at about a 3% annualized pace in Q3. And ultimately, consumers are extremely worried about their job prospects and tariff-induced inflation, but they continue to spend. And part of this, I think, is really just due to the fact that the income is still flowing into the household sector. So even though we've seen some moderation in the jobs market, most of the population is still employed and still clipping a paycheck, which has remained supportive of spending. So to that end, Charlie, what are our expectations for the jobs market as we head into the next year?
Yeah, so right now I would say the labor market still looks to be pretty soft. So the federal government is shut down, and that means we haven't yet seen the BLS employment report covering September. But if you look at some of the private sector sources of data, right, such as the ADP payroll print, it basically shows more of the same in terms of September compared to, say, August. So what that means is employment growth is probably moderate, right? Hiring has come down and remains pretty slow. You're not seeing layoffs really run up. So it's still consistent with that low hire, low fire type of labor market that we've really seen for much of this year. Now, we are anticipating that to sort of continue over the next few months, right? Because the Federal Reserve still has monetary policy in a restrictive stance. Economic uncertainty is still pretty high, and that's hardly conducive to a robust hiring environment. But overall, we're still expecting this sort of sluggish, soft labor market to kind of persist here. So Shannon, the labor market looks like it doesn't have a lot of energy right now. What about inflation? What do you see happening there, and how does that impact the path of monetary policy?
So inflation, I think, has been stubborn but contained from the tariff side thus far. So if you look under the surface of inflation, you've seen a pickup in core goods specifically, which we can attribute to tariff price pressure starting to flow through to the consumer sector. But at the same time, you've had a disinflationary tailwind on the services side, which is kind of limiting the increase in overall consumer inflation, right? We've seen more of a sideways move over the course of the year. Now, when we think about inflation going forward, we still expect tariffs to meaningfully lift inflation headed into 2026. The tariff rate, by our estimates, was around 2% last year. It's risen to north of 11% through August based on tariff collections and import growth. So that will show up and manifest in higher consumer inflation as we move forward. But the moderation in the labor market, as you just described, is keeping a lid on wage growth. So you will get somewhat of an offset coming from the moderation in the labor market, keeping wage growth at bay and allowing for some reprieve, particularly for service providers in the United States. So contained thus far, but signs of inflationary pressure are there from tariffs and likely going to continue to boost inflation headed into year end and into next year. Now, what's the Fed to do in this situation, right? They're obviously in a bit of a tricky spot between their two mandates of price stability and maximum employment. The Fed has started to prioritize their maximum employment mandate, and we expect they're going to continue to do so. So we have not changed our forecast for Fed easing. We still have 2 cuts baked into the forecast this year. So one later this month in October, a 25 basis point cut, and then another 25 basis point cut in December, followed by 2 more cuts in the beginning of next year, the first half of next year. So it gets you down to a Fed funds rate of just above 3% at the upper bound, which we consider just below neutral. So not an overly stimulative stance on policy, but no longer restrictive, as you've mentioned, in terms of exerting that pressure on the labor market. Now, we've talked about we're in the midst of a shutdown. Is the Fed going to have the data in hand for the meeting later this month? And that obviously remains an open question, but it is possible the Fed does get the September employment report. And we have learned more recently that the Bureau of Labor Statistics is bringing workers back to get the CPI report out by the end of the month. So it is likely the Fed should have some data in hand. And to your point that you made earlier, Charlie, the private payrolls data and the data we do have on the jobs market does suggest there hasn't been a shift, and we've continued to see that moderation. So we do still think the Fed would move forward with the cut come later this month.
Well, Shannon, thanks for joining us. And from all of us here at Wells Fargo, thank you for tuning in. Please join us again next month for our latest monthly economic outlook.